Hello and a warm Collisions YYC. Welcome to my guest, returning guest, Mr. Mark Mitchell. What's going on, Mark?
Not much, Tyler. How you doing?
I'm good, man. So good to chat with you. We're just joking. I think this is our number 4. This is like, we're getting serious about this relationship. We take time apart, but we always come back together. Well, there's one for 5, so don't be careful. You will be careful what you ask for. We do have a 5-timers club, but that's a whole other thing. Thanks for coming on, man. Thanks for spending the time. I always enjoy. I think way back, I think over 4 years ago, our first chat. The world has changed from a VC perspective, tech perspective, Western Canada. So we'll touch on that. But you are general partner at Weave VC. So I always want to never assume anybody knows anything, including myself. Let us in. What's going on? What is Weave? What's your kind of reason for being in the world? And give us a little bit of an info about it.
Yeah, totally. So Weave VC is really trying to invest in pre-seed technology companies, primarily in Western Canada. So we're a venture capital firm. We launched our first fund in July 2022 with the goal of really filling that gap of kind of that first $500,000 to $2 million that technology founders will look to raise. So typically we're co-investing with angels. We're a little later than like just the pure angel round, but we're typically leading a round where we're the biggest check and there's some angels that will syndicate alongside us. So that's really what we VC is trying to do. There's not a lot of, I would say, like funds of our size because we are a smaller fund. Yeah. We can play at that very early stage. When you start, getting bigger and bigger in terms of assets under management, it's very hard to actually write checks into that kind of first like 500K, million and a half round. Just because your fund's so big that it's hard to justify such a small check.
It's too much paperwork for the value that you're going to get. Really, almost. Totally. I know it's more than that, but that's kind of what it comes down to.
The fund economics don't
just to administer it. So give us again. I love this world because there's so many terms that get floated around and sometimes mean different things. So break down when you're sitting with. If you think about your last 2 or 3 investments, and we'll get into some of your companies down the road because I'm really curious of who you're excited about. But what's the profile? We've got product market fit? We've got a bit of revenue. We've got a cap table that's friends and family. Like, what's it kind of give us a profile? What's it look like?
Yeah, for sure. So I'd say there's early signs of product market fit. And the way that I think about that is like, if you're thinking about a SaaS business model, so someone that's selling like a subscription, technology application, that would be like, 10, 15K in monthly revenue. Okay. They have like a dozen to 15 customers. We have the opportunity to speak with a few of their customers. And we can actually get an understanding of really the problem they're solving. I think like even backing it up before that, because we are investing quite early, like typically we're finding these companies well before they're raising money. Like we're building those kind of, we're long-term relationship, a lot of data points, a lot of touches with the founder, getting updates. They tell us they're going to do something. 6 months later, we reconnect. I was
just going to joke. They're doing what they said they were going to do. Exactly. It pretty much sums it up, man. Yeah.
and that's, that's really what we want to see is like a lot of those data points. And then when they do, come back to us and say, hey, we're raising a round of financing. It's like, it's a lot easier for us to get that conviction, even though the company is quite early still in their life cycle. So that's really important for us is getting our kind of tentacles out there, meeting as many early founders as possible, and then building those long-term relationships leading up to that first kind of fundraise, where then we can be, ideally the lead or the co-lead in that first round.
That makes ask for money before you need it, build the relationships before you want to invest, like all those cliches.
Totally.
When you're at that stage, are you excited about the problem that's being solved? Are you excited about the space that they're in? Or are you excited about the founder and the team? Like, I guess it's all of those, but what's your shining star?
Mm-hmm. No, that's a great question. I would say it definitely comes down to the founder, right? Like, I think that's the biggest thing that needs to be checked before we really even want to dig into like the business model and the customers and the market dynamics and the market size and like all those kind of table stakes things that, we will dig into as VCs. It really comes down though to the founder first, right? And like, we want to know that's the right team to solve this specific problem. Like what unique insights are you bringing to this problem? Like how did you come about this problem? What has been your experience like understanding this problem and the customers you're looking to target? There's so much that goes into just like, is this the right team? Right. And then there's more things on the qualitative side as well. Like, what kind of history or experience do you have? Like, building a company or, working within a large organization that touches these end customers in some way. Like there's a lot of stuff that goes into just understanding that like founder product market fit, which is like it's such a cliche. It's very cliche, but it's, I know, I get it. It's so important, right?
Yeah, you might have identified a great problem, a real problem, but are you the right person? And I guess there's got to be, back to the joke about dating, there's also got to be, they have to be the right kind of human being. You got to be able to get along with them. They need to to be open to advice. They have to know that they have to be confident enough, but also to know that they're not always the smartest person in the room, but they got to feel that way sometimes to be able to even do the thing that they're about to do. I guess it's a tricky balance, right?
Mm-hmm. Absolutely. Yeah. And like we want to be able to work with them for a long time.
Yeah.
So I think oftentimes like founders sometimes underestimate how important that is. Like it is, you're building a, it's a 10-year partnership basically, or longer. Like,
or longer.
It could be longer, right? So that's a long time to work closely with someone. And you want to make sure that you jive with the team. Like you have to get along. We want to become close with all these founders. So that's super important.
Many a good thing is blown up because the people couldn't get along. Like it is what
totally.
It is.
Yeah. That's actually, I think that's like the biggest risk of early stage companies failing, right? Is like founder splits, or there's some like, rift within the founding team. There's, it's always like
bad breakups,
people,
man,
right?
Bad breakups.
Yeah, totally.
For you guys, when you're going in early stage, you're writing that check, you're often leading the round. I've often heard, and I've heard this maybe even a couple of years ago more so, like, man, we need some more patient capital. Like we need companies that are willing to kind of be on the, like you said, the word 10 years. That's what kind of triggered it for me. Do you think of yourself as patient capital, in it for the long haul? Like there's such a balance of like, I want to put my money in and 18 months later, double, triple, 10X versus I'm in for the long haul because I know this is going to be like a process. How do you balance off that? And kind of what's your philosophy at Weave and even your personal philosophy? Because you've been in this game for a while.
Yeah, that's a good question. There's a lot of ways I can come out with an answer.
The floor is yours, sir. The floor is yours.
I would say just generally, like I think it comes all the way back to kind of like how we are talking to our limited partners about investing in our fund. Our conversation with these folks that are now limited partners in our fund is really like, hey, this asset class, we gotta look for the future. This is a long-term game. We have to be patient. Nothing's going to happen right away. If we get a couple, quick wins under our belt and we get a company that, gets acquired at year 4 or 5, or, we're able to sell a secondary at a large future financing round, that's great, but that's not really like what we're looking at it for.
Okay.
From the initial investment, right? It is a long-term, growth opportunity. So that's kind of how we frame it to our investors. And I think because we frame it in such a transparent way and people who invest in our fund understand this, they're actually investing in our fund for that type of investment. It's a lot easier for us to look at the founders and understand that that's going to be the dynamic. It's going to be very long. And that's okay. So I would say, yes, we're very patient. If things happen, sooner than later, like that's okay. That's great if it makes sense.
Yeah.
But we're not underwriting it from that perspective. We expect these things to take a long time.
Well, you said 10 years, which I've heard that before. And is that 10 years also a bit more of a Canadian phenomenon than I've heard the US? It can be a bit shorter, but Canada, I've heard that 10 years before. You're not the first one who's just throwing it out that way.
I think the reason that most people say 10 years though, it's maybe not even a dynamic between US or Canada or different markets. Okay. It's probably just because most venture funds are 10-year vehicles.
The way it's structured right.
Like the limited partnership is actually a 10-year vehicle. So that's usually why people say 10 years. And 10 years is just, it's so far in the future that like, we're like, oh yeah, this is a long-term investment that's 10 years.
Yeah. I got it. Totally.
But I think it is more like the legal structure of a limited partnership. I would say,
enough. Okay, cool.
It depends on the market. I think also in terms of like how fast things can happen. Like it depends on market dynamics, macro conditions. There's a lot of factors, and like also just different industries. Like there's a lot of stuff with AI right now that there is some companies that are, they're starting and then 3 years later they're getting acquired for like a huge number. And so I think, also part of our job is trying to be really early on these big waves of innovation. Right. And sometimes if you can do that, like, maybe there's a higher likelihood there will be acquirers that will want to come to the table in a more expeditious timeline.
Yes, makes sense. Yeah.
But again, that's not like, we're not framing the initial check from that perspective. It's really like a long-term, very patient game.
Yeah, it's like building a piece of content with the intention of it going viral. That's a really tricky thing to do.
Exactly.
You make good, solid choices. You deliver on your content. You make an awesome, whatever it is, video, and maybe it goes viral, maybe it doesn't. But I've had people call us up. I want you to make me a viral video. I'm like, it's like, I want you to make me a unicorn, no questions asked. I'm like, well, that's okay. Not necessarily how it works.
We just try to make the best decisions we can, right?
Yeah, with the information you have at the time.
Yeah,
absolutely.
Exactly.
Hey, what was the fund size? You closed in July 22. I remember, I think we chatted around that time. I can't remember. What was the first initial fund?
So we did our first close in July 2022.
Okay.
We're in the process of doing our final close right now.
Oh,
so
okay. Got it.
By the end of summer, we should probably, like early September, we should be able to make an announcement, and we'll say what our final fund size is. We've raised around 7 million so far for the fund. So we'd like to get it to maybe 8 million.
Nice.
And that'll give us enough to do like 15 or 16 really good core investments, with a follow-on strategy as well. Also just line up the story for a future fund, right?
You're always getting ready for fund two. Yeah, absolutely.
Yeah, definitely.
And there's a lot of investors and a lot of LPs, and depending on as you go up the chain, that they just fund one is not where they invest. They wait to see some track record.
Yeah.
Like there's so many like kind of the social dynamics of who invests where into what and what type, back to your thing about check size.
Totally.
What's the journey been even from July till now in terms of LPs? Like we all know the market tightened up. We all know that 100%. There's been some changes. What's that journey been like for you guys actually on the inside of it?
Yeah, so it's been about 2 years that we've been raising this fund, right? And I think that's kind of standard for like a first fund, right? Especially in Canada, especially in like a down market. I guess there's a lot of things like working against you as a first time fund manager, right? Regardless of like the market conditions, people do just want to see a track record and they want to see how you're performing. And of course, like, if you're going to put money into something that is like long-term, 10-year, 12-year, investment, like you want to understand the people that you're investing in, similar to how we approach, our investments with our founders. Like we want to see the data points.
Like you're literally in the middle of that situation, 100%. Kind of from both sides, right?
Yeah, 100%, right? And I think the other thing as well is in a market like Canada where it's a little more, I would say, like in development in terms of people's familiarity with investing in venture funds. Mm-hmm. There is that kind of like educational almost process in terms of like, hey, what is venture capital? How do you underwrite these funds? What do you expect as an LP in terms of returns, in terms of timelines, how to approach it versus like some of the other asset classes that you're maybe more familiar with? And then also like what percentage of your kind of overall portfolio even makes sense for something like this? Yeah. Like we're a venture fund, but within venture, there's also like a bunch of different strategies, right? So, you can kind of take us as like actually a very small portion of like the overall venture market. So if you're an LP and you want to allocate to venture, okay, it's like, maybe this is my total allocation to venture. Maybe it's like 3% of my whole portfolio. Right. But then within that 3%, what types of funds? Like we're a very early stage fund. There's later stage funds as well. That's a different strategy, right?
Have you seen, I've heard certainly a lot more attraction to this asset, this aspect of the venture class lately, of so many like companies that maybe played a little farther downstream or a little farther down the chain coming into this space just because the potential for upside. Are you seeing that as well? Or what's your perspective even? And I'd say even in the last like 12 or 18 months.
Are you referring to like investors in venture funds?
But I've seen larger funds that typically are at later stage that maybe are a Series B or typically going, hey, we're going to actually spun up a fund that focuses on early stage venture. And of course, LPs, I think I've heard a mixed bag of some people that I know that were kind of played in the angel space and went, hey, this isn't actually my level of expertise, but I still want to get access to the class. So I'm going to now partner with a Weave or a Tallgrass or a Metiquity or like some of the ones that are becoming a little more mainstream names around Alberta.
Yeah, so I've definitely seen that phenomenon, right? Like both on the more established manager side, allocating capital to the early stage, either directly into companies or more likely actually as LPs in funds like ours. So that is, and that phenomenon has been happening for a lot longer in the US, like firms like Andreessen, Sequoia, like all these large kind of mainstream venture funds in the US.
The names, the name dropping names. Yeah,
totally.
Absolutely.
They've been doing this for a long time, actually allocating some of their fund or spinning up another vehicle to invest directly into emerging fund managers because like they want to see that early stage deal flow. They want that vetted pipeline. It makes their job a lot easier in terms of picking off the best like Series A opportunities, which is typically like where those firms would start investing. And then on the angel side,
back to getting it early, which is what you started off your comment on.
Yeah. And then on the angel side, like actually what you described is the majority of our limited partners. Like I would say like 80% of our partners now, and we have 29 limited partners today.
29, cool.
They started as just, they're angel investors. They want to invest in the early stage asset class. They like it. They like the opportunity. They like how it makes them feel, like in terms of the emotional return as well.
It's like, very like you got a getting involved with your community vibe to it, 100%, right? Like for sure you 100%. Do. Absolutely.
That's that's a big part of it, right? And so, but again, like what you were saying, like some of them realize, like, hey, this is actually, if I want to do this properly and build a proper portfolio construction,
if I don't just want to donate money, yeah, absolutely,
totally, I have to allocate a lot of time to this endeavor, right? So hey, maybe I'll just throw some money to Mark and his team, and I'll pay them a small fee every year to do this for me. I'm
hearing much more of that going on lately in my circles, for sure.
Yeah. So that's kind of our, I would say, our ICP. Like that's like our ideal customer, right?
Yeah. I went to a presentation. Well, I'm sure you know Jacques and Brian from Antiquity.
And Brian, yeah, of course.
Yeah, and talking to Jacques a lot about it and being an investor himself, and like so many people want to play in this space and they just get in over their head because they're not sure. They're maybe very savvy and very successful in their field, but there's some disciplines and there's some things here that aren't maybe as easily recognizable at first blush, because nothing like a little success to make you feel as an investor that you're going to be good at everything. And that's just, unfortunately, I don't think that's true.
Yeah, for sure.
Talk to me. Okay, let's talk about your portfolio companies. What's going on? What are you seeing? Like, are you excited about it? Are we flooding the market with amazing founders just looking for checks? Like, what's going on that side? The people that are changing the world that we live in, one company at a time.
Yeah. So, like, and if you talk to any manager, they're going to be very biased towards their own portfolio.
I hope so. I hope so.
I love like our companies. I love them. I will sell any person on our companies any day of the week.
That is the best answer for anyone listening right away.
I can talk for hours about every single company because I think they're all doing incredible things, right? And like, we are looking for companies that are solving huge global problems. So just by that nature, like I'm super excited about every one of our portfolio companies. I would say just generally, like in terms of the market, like, yes, we are seeing a lot of founders raising capital. I think it's probably less than what I saw in like 2021, 2022.
In the fever pitch time that was, yeah.
Totally, yeah. Like, and also like I think founders are starting to realize like, hey, maybe before I go raise capital, I should figure out some fundamentals of my business. I should figure out a little bit more about my customers. I should start to generate. I can't
help but chuckle at that, but I think we all know. Like, I had a deck and I raised $5 billion versus okay, do you actually have a business?
Yeah, exactly, right. And so, and I think that's a good thing, right? Like it seems like that's more how it should be, right? Like you should have to understand a little bit more on your market and your customer, and the product market fit should be there a little bit before you think that, I need to raise like $1 million to accelerate this thing. Because you have to understand kind of the machine before you understand how to put fuel into the machine to actually make the machine work better and grow.
You said something to me years ago that I remember. You're like, Tyler, let's be honest. If they could do this without taking my money, they probably should. And it was such an honest statement. And remember that. I don't even know how long ago you said that to me, because it's so easy.
Still true.
Yeah, it's still true. I love it. It stuck out in my mind as a quotable Mark Mitchell quote.
Yeah.
It's so often like, no, you start your startup and then you go get a bunch of money and you get diluted. And you're like, I just really appreciated the honesty in which you said that, like just in passing in probably 2 podcasts ago for that matter.
Yeah, totally. Right. And I think,
still
what
true.
is interesting,
still true.
Yeah, it's still true. What is interesting though, is like, back to kind of the fundamentals of like the VC founder relationship and then also the VC limited partner relationship. we are looking at these things as extremely long-term, intimate relationships. So as a founder, if you're raising money and you get someone to say yes in like a week, how on earth are you going to be sure that that's the person that you want to spend such intimate time with over the next 10 years? It's like if you met your wife and then 5 days later you proposed. Like
that sounds like a bad trip to Vegas, but anyways, yes.
It doesn't sound like a good, it's not a good idea, right?
Every single person you tell is going to go, but they're the spouse of my dreams. Everyone's going to go, oh my God, what have you done?
Exactly. So I think just like, taking more baby steps, getting to know, the founder better, getting to know the VC as the founder, us getting to know our limited partners. Like, yes, things are slower and that can mean they're harder and you have to plan more around your fundraise. You got to be very cognizant of your burn and your cash situation, of course. But I think in general, like it is probably better because, we get to spend a lot more time with the founders before making a decision. No one expects you to make a decision right away. There isn't this kind of high pressure of like, our round is closing right away. And again, like maybe that's different in other markets, right? Like if we went to New York or Silicon Valley, like maybe that dynamic is different and it still is maybe like a feast or famine kind of thing in terms of just being so competitive as venture firms. But I think in Alberta and Western Canada, it's not like that. It's much more collaborative. People get to know each other and that's a good thing. So, for us doing due diligence on new opportunities, like we get to spend the time really understanding the founding team and really understanding the problem they're solving and their customers. And we get to talk to a lot of customers. And, that's more of like how I want to approach early stage investing, because again, coming back to the long-term nature of it, like you're going to be spending so much time with these companies for a long, long time. Like you need to understand them very well to make the best decisions possible. Right?
If I had a group of founders in one room and I had a group of early stage investors, in the other room, and I asked each, do you have enough opportunities to raise money when you need it? And do you have enough companies to invest in when you want to? What's that balance like? What's the equilibrium look like between those two groups?
I would say there's so much like, it depends. Like there's nuance, like there's so much like, caveats in there, right? Like I think for the investors right now in Western Canada, like, yes, there would be enough for sure.
Okay.
Whether they're all great opportunities that we all want to invest into, like that's another question, maybe TBD on that.
Okay.
For the founders, like I think people would probably still say no, like there isn't enough money. And I still think that, right? Like that's exactly why we started Weave because we want to be that.
You saw that there was a gap. There was a gap to still at the end of the day. Is there a gap to be filled? And am I the best person to fill it? Yes. Okay. Let's
totally.
Go. Yeah.
And I think like, having more of a culture of like new and emerging fund managers is an amazing way to fix that. If you look at even just like kind of the dollars, per capita invested in venture in Western Canada versus Eastern Canada, like there's a huge disparity. I think it's like $137 per capita invested in venture in the Western provinces versus like $427 in Ontario, Quebec. So it's a pretty big gap still. So that's,
so I think when we tout how awesome it is and how we're moving in the right direction, we're still early. Like we're still,
oh yeah, for sure.
Like, it's so easy to drink your own Kool-Aid. Like, oh, things are awesome here. And I think I was at a presentation that Jacques and Brian did, and they showed, Austin. And just like the amount of startups, and it was like Calgary was like a dot, like the graph they had. It was, oh, you think we're doing awesome? This is what awesome looks like. And like, they're like not a negative against Calgary, Alberta, but it was the perspective that it's so easy to see your own shadow and think you're taller than you are.
Totally.
It's like, oh, here's what's actually going on.
100%. And I think it's, it's not to say that we ever need to like get to that level, right? Of an Austin or a New York or a SF.
Yeah, but it gives us perspective. It gives a perspective.
Yeah. It gives you perspective. Like I think just being able to be like in more balance across Canada, would be awesome. And I think just getting more new managers, involved and like building kind of some supports and building like more of a culture around new and emerging managers. That's also really important. Like, getting people familiar with what it takes to build a venture firm. Because, from our perspective, when we started doing this, like we were kind of just like, okay, let's just do this. Let's just jump in with both feet. We're going to dive into the deep end. We have no idea how this thing's going to scale, but we're going to try. And I think that's a pretty hard decision to make. I think, to be honest, like in hindsight, right?
I can feel the weight of it.
we're like very, I would say like purebred entrepreneurs in that sense, where we just wanted to do something and we just did it. And I think like there's a lot of people that probably could do it, but then there is a lot of calculations that a lot of people would make, I think, in terms of the kind of risk reward of actually jumping into that journey, right?
And having the long-term game in mind, right? It's not a get rich quick scheme.
Maybe it's a get rich slow scheme.
Yeah. Well, that's the hope. That is the hope. I think, which is we can all hope, and you can cause impact along the way.
Exactly.
Talking about pivoting a little bit to technology, emerging tech, things like AI. If I called you tomorrow and we hadn't met, and I was like, Mark, I've heard about you. I have the AI technology. It's going to be a unicorn. It's going to change the world. Do you roll your eyes or do you get excited?
I roll my eyes.
I wondered. I didn't want to lead that question where I thought it might go.
All the way in the back of my head.
So what's coming across your desk, and what aside from AI being the answer to absolutely everything, what's getting you excited? What is causing you to eye roll? And then maybe what's getting a second look right now, technology wise, tech wise?
Yeah, like I think every company we see now is quote unquote an AI company in some way, right? Whether that's like actual core technology they're developing, or they're just slapping on like kind of an LLM and helping out their existing business model, which is fine. Like everyone should leverage the technology.
Everyone should be optimizing in some way, efficiencies, workflows, all the things.
100%. What I would say, what I'm like, so fundamentally what I've always been interested in, this hasn't changed, is founders that have bootstrapped to some sort of like early stage product market fit. They really understand their customers. They really understand the problem they're solving. They would do it whether we invested or not. Like they're going to be successful.
Yeah. Mm-hmm.
And that comes down to like, we got to get to know these people really well. They have to show like that early resilience and grit of like, hey, we're going to get this done. Like we don't even need to raise money. We're just going to get it done. But us giving them a little extra money, that helps, again, make the machine run better and allow the machine to grow. Mm-hmm. And, you have to understand your customer and the market and the business model dynamics to a certain extent before we can even know that would actually happen if we invested, right? So that's not changed. I would say in terms of like some interesting, aspects of industries that I'm, particularly excited about right now, I would say it goes like below kind of the application layer.
Okay.
So like as investors, as venture capital investors, we see a lot of applications. And so that would be like a SaaS software.
Yeah.
Like so many people are building a software, a company will subscribe to it, they get to use the software application. That's great. But what actually goes into allowing that software to work? And especially like in an AI perspective, like what are the different layers of the AI stack? And what are the companies that are actually building things within those deeper layers, all the way from like application down to silicon?
Yeah.
So who's helping with orchestration? There's all this data that has to go different places when someone does an API call. Like how is that data actually moving? Like what are those infrastructure layers? Like what are the deeper layers in the AI stack that actually enable the applications to work? So that's like actually more where I'm spending my time. It's kind of going back to the basics, right? It's like
it's the gold rush. And are you selling bags to carry the gold, or are you selling shovels, or are you selling a map to get there? Like really understanding where you fit in that journey, right?
Totally.
And the guy that sold shovels sold a lot of shovels, whether you dug up gold or not.
100%. So that's something that I'm thinking a lot about, right? Is like, hey, there's a lot of applications, and these are the companies that we all see all the time, and it's really easy to make an exciting pitch around an application. You can get to early product market fit quickly. You can start generating revenue because it's a SaaS model. But actually, what's enabling the application to work? Who are those companies? So that's actually more.
And that's often so much more scalable across a broader, because that's the shovel. It's not the actual thing. Yeah.
Yep.
And so obviously, to me, that immediately implies that the founders or that the companies that you're investing in are a little more tech savvy. They're deeper. There's a higher level of like, hey, I'm taking this because I might have industry expertise where like, oh my God, I'm so sick of seeing this problem. I want to solve this problem. Then there's a founder that's like, oh, I think we could solve this for a whole bunch of different applications. And that's a whole, back to your point about global scale.
Yeah, for sure.
Those feel like they might be a little harder to find in the haystack. Is that my thought?
100%. No, they're definitely harder. And like I think it requires a lot of like thesis building and research and, just almost information overload if you're not like a technical person, right? And like myself, my co-GPs, like we don't have technical backgrounds necessarily, but that doesn't mean we can't dig in and really understand the technologies we want to invest into. And so we do that. And then you can start to understand, okay, who are the companies in Canada kind of at the early stage that are actually doing that? So it's almost like instead of getting inbound and vetting a bunch of deals, you're actually building a thesis and then you're going outbound to try to hunt those specific opportunities.
Oh,
so it is like a different paradigm in terms of how to approach doing these investments. And I think most venture firms, especially in Canada, they take the former, right? Like they're actually just filtering, like they've gotten really good at filtering.
Yeah.
And then they're making decisions based on their filtering. But I think what would be more powerful and what I'm really trying to think about is how do we do something where we're actually hunting? We're building a thesis and we're hunting opportunities. Because that's
very different model. Yeah.
Very few people in Canada do that well.
Well, it's just understanding it from the it's harder. it's way more difficult.
Yeah.
And for that type of a model to work, do we like? Back to the point about is there enough opportunities or is there enough founders that fit that formula for you, or does that force you to expand beyond Western Canada to get enough of it? Because again, the candidates become less, right? The more specific you get.
Yeah, no, absolutely right. It would probably force us to expand beyond Western Canada, but on the same token, like most venture funds, like at least the strategy we're doing, we're not trying to invest into every deal. We're investing in like 15 companies over a couple years. Like that's, seeing like 1,000 companies, 2,000 companies, only investing in 15. Like it's, that's not, you don't have a lot of like bullets, right? Like you got to be very selective. And so that's kind of like, we're trying to bring our framework and our thinking really back to fundamentals and understand like, hey, what are the technologies that are going to drive this kind of AI wave or the next level of innovation for the global economy. I don't think it's going to be these applications, like, because a lot of these applications will consolidate. There's going to be maybe a lot of commoditization because there are all these AI applications. But what's like the enablement layer? Those seem like they're going to be the more enduring businesses, right? So, but again, like you said, it does take a lot more time. It takes a lot more thoughtfulness, research. You have to read a lot. Like there's a lot of stuff that goes into that. So yeah, there's pros and cons, right, of each approach.
But to your point, like any business, you've chosen what you think is going to create the most value. So you've gone all in on it, and don't just say, oh, we invest in early stage companies. That's fairly broad. Underneath that, how does that segment out? And so, well, we do it this way, and what, everyone has their secret sauce, value prop, way of doing things, and if your core competency as a team is getting really good at that and understanding that layer, to me, that's an interesting differentiator. That also takes just a little bit to even understand for someone who's like, okay, well, what do you mean application layer versus, the plumbing, basicly selling. We're in the shovel business, not the digging hole business. Yeah,
totally.
I don't know why the gold rush, though, not metaphor. I've read that somewhere. I'm like, it feels like it fits.
It's a good analogy for sure.
So how many companies? I'm on extended portfolio, general partners, previous venture investments. Out of the 15 to 16, where are you guys at now? What's your numbers look like?
So we're just finishing number 8.
Okay, nice.
Yeah. So hopefully in a week or two we'll be able to announce this 8th investment that we're finishing up here.
And just to put in context, what was from like first date, for lack of a better term, to like potentially being able to announce it? Was that 6 months, 12 months? Have you known these guys and gals for a couple of years?
So this is a very unique one. So this company I've actually known for 5 years.
Okay.
So I've known this company.
It proves out everything you've said so far, Mark.
Yeah.
Your story checks out, my friend. Your story checks out.
So I've known this founder personally for 5 years.
Okay.
I've also been involved as an early angel in this company for 4 years.
Nice. Okay.
So this is
you've been on a few dates. If you guys have
totally. Yeah. We've watched them grow. We understand their customers. We've talked to the founder, probably 50, 60 hours. There's a lot that go, and that's kind of back, like what you said, like, it's like, you're doing these long-term investments. Like you really need to understand who you're investing in. You got to understand the personalities, the team, their motivations. Like, what do they want to do? Like, how do they measure success? Like, there's all these things that are it's very hard to understand those on a deep enough level in like, an expedited fashion.
Okay.
Yeah.
Yeah, there is just sometimes like the osmosis is a real part of the journey, right? You're close to them, you're aligned, you hear things, you learn things, you get more comfortable, and you get a deeper level of understanding that happens slowly, and then all of a sudden.
100%.
On a broader scale, if you look out, crystal ball question. So if you don't have an answer, it's fine. If you look at I look at the next 3 to 5 years in Canada, we've got an election in the US. I don't want to get it. This is not a politics. This is not a conversation about politics. Potentially an election in Canada, obviously interest rates. Do you see anything that would be either headwinds or tailwinds specifically for this venture space?
Yeah. So I think in terms of, things that could hinder the growth. So I do see like more kind of chatter and like ideology around, looking down almost on people, becoming successful generally. Right. And so that's, I guess like one example, right, is like kind of the capital gains tax, increase, right? Like that's, it's an example. It's not like the, end all be all. But it is example of like legislation that was created. I think coming from an ideology of like, there's people out there that are doing really good. There's a lot of people that maybe aren't doing as good.
Yeah.
How do we balance things out? So, I don't love that way of looking at the world, right? I want everyone to have opportunity, but I also want people to know that like, effort and work and research and time spent perfecting a skill or honing your tools, that's not going to be equally distributed. That comes down to the individual, right? And
setting up structures like that, it can look very punitive for extra effort and time spent. And I don't know if you've read Atlas Shrugged in the last few years, but there's a lot of some of those old ideologies start to come out like, if we step on everybody who's working their ass off, they're eventually going to stop. And that's bad for everybody, right?
Totally. They're just going to leave, right? So like for us as early emerging managers raising a fund, it's like, we can't make it harder for people to decide to invest in this asset class. Like we need to do everything we can to make it easier. Even though on the surface it might not look like too big of a deal, it's like, it's a little bit of an increase in capital gains. I think like if you extrapolate that out to what, could happen if you keep going down that line of thinking and that line of thinking that that's acceptable, people are just going to like leave, right? Like founders, investors, they're just going to say, see you later. I don't need to live here. I can just go move to Austin, right? As an example.
Touche. Yeah.
Why? So those are like really important things for people to consider, right? And so I don't like that. That's not good for our innovation ecosystem, right? And then I think in terms of like things that we have going for us, right? There's a lot of positive things too. I think there's a lot more technology companies that are being started in the last couple of years in Western Canada. Entrepreneurs are hungry. They want to solve huge problems. These are just things that we're seeing every day, like live in real time. The entrepreneurs that we talk to are they're all working on something incredible that has potential to be a global company, and that's really exciting. It's really it gives you optimism in terms of like how things are progressing, right?
Yeah. So being out there and seeing it and talking to all these founders, and you get rose-colored glasses, but in a good way, because we're always talking. People ask me on this podcast, what's your view of the economy based on all your guests? I'm like, everyone I talk to is excited about the thing they're doing, so it gets to look really positive really quickly.
Yeah, 100%. I think
which is not a bad way to see the world when you wake up in the morning either, right?
Totally. Like there's always kind of that macro view where if you look very broadly, like you can start to see things that maybe aren't great. But then always you can come back to kind of the individual and like, what are the conversations you're having day to day? And that can give you optimism, right? So, there's a balance between kind of those two viewpoints. But I think generally, like the reason we're doing this, the reason we've dedicated as much time as we have, the reason we, raised this money is because we are optimists in how Western Canada, how Canada broadly will grow over the next decades.
So last question, maybe, why Edmonton? We were joking. We were joking about this before we got on, so I thought I'd throw it in at the end just for shits.
No, that's a good question. So I mean, like a lot of people, right? Like you end up living somewhere where you probably have the most relationships and the most kind of foundation in terms of family and friends, right? And so for us, that was kind of the main reason we ended up being in Edmonton. and why we stay in Edmonton. I think we chatted about this a little bit before we started recording, but I think as like an entrepreneur, as someone who's just super busy, wanting to do everything all the time, it's important to be able to actually do like deep work. And I think it depends on your personality, like how you can approach this. But for me, like being in a place where it doesn't seem like as noisy in terms of just events and people that want to meet you all the time, I think that's more like Edmonton. And it allows me to do like deep work during the week. And that's super important, because we're building a business. Like there's things we just need to do that don't necessarily involve going to events or meeting people or having conversations.
I call those Sunday morning tasks. I'm like, I got to get a coffee. I need to sit at my computer. Exactly. There's no tenant. I don't even need to check my email because nobody's emailing me. And I need to actually get some shit done.
Yeah. And then I can be very intentional when I do want to go to those events, when I do want to meet certain people. I can go to Calgary. It's really easy. I go to Calgary every month almost. I can go to Vancouver. I go to Vancouver like every 6 weeks. And when I go to those places, I know like, okay, these next 48, 72 hours,
I'm going to go hard. Yeah.
Go. Yeah. This isn't deep work. This is like you're meeting people, you're building rapport, like all those important things. And that's, that is like, I'd say a big part, maybe like 50% of our business, right, is still that relationship.
Well, back to your point about, your latest investment, that's a 5-year relationship. There was lots of bumping into them, running into them, grabbing a drink, a coffee, whatever it is. But I do really appreciate also, and I know, like, again, just I think it's important. You also have a young family. That also requires time and effort and energy to be done well.
100%.
And so, I appreciate it. Hey, I'm all in. I think as a province, we're too small to be Calgary versus Edmonton. That's ridiculous. We don't have enough clout to be that way, but it's fun. Yeah. It's a little bit of rhetoric. And, we know your hockey team did pretty good this year or whatever. But anyways,
exactly. The Oilers too, right?
Yeah, I grew up in Montreal, so everyone like shit on Toronto. But then I moved here and then I realized everyone still shits on Toronto. But that's a whole other joke for another time. Mark, so good to have you on, man. 4 times in, 4 times strong, and I will bold to say that was one of our best. That was one of our best conversations so far.
Thanks, Tyler.
If anyone wants to get a hold of you, obviously, you're J. Mark Mitchell. That took me, but now I know how to look for you on LinkedIn. The first few times, like, where is this guy? I can't find him anywhere. But what's your favorite way for someone to get a hold of you?
Yeah, I mean, LinkedIn's great. I think email might be even better. So Mark, M-A-R-K, at weave, WEAVEVC.com. Shoot me an email. I mean, go to our website, go to the WeaveVC website. We have a blog. I'm pretty passionate about always like updating people and the community on what we're up to. And if you're a founder and you want to connect with our firm, go to our website, fill out an application. We can hop on a call. We can talk about your business. So
amazing. Awesome, man. Thanks for coming on. Thanks for the awesome work you're doing in the province. And I love it. I look forward to number 5. Then you'll be in the 5 Timers Club. It's a whole other world, man. Things change, man. It'll happen.
I'm excited. Thanks so much, Tyler. Really enjoy your chats.
Thanks, brother.